Okay, what I'm going to show you next is what happens when we do the same calculation, bringing into other taxes, but particularly the benefit side of things, such as the unemployment benefits, and there are many other benefit programs, Medicaid benefits, food stamps, we call it, or nutrition program benefits. Now, when I show you this, it's going to be at a higher level because there's disincentive, of course, from the personal tax, but also from those other things. It's very rare for a program to subsidize work. It's typically adding a tax to it. So we're going to be at a higher level. So what I'm going to do is I'm going to have a new axis on the right here to recognize the higher level. The spacing will be the same. It'll still be 2 points. 2 points per tick. And that's what I did here. Now there's a lot of action. Very big increase. Something like an 8-point increase in quite a short period of time. Decrease and then an increase in the end. There's, again, this is a statutory rate, so every single wiggle here in the red line is happening because there was a change in the rules. Most of these are because a new law was changed. Sometimes there were changes in regulations in terms of enforcing those laws. So there's a big change in disincentives here. And we don't have time today to follow up, but they might want to follow up on, well, did that affect behavior? How much? Who? Those are obvious questions. And we can make a nice first pass at those questions once we know what the disincentives are in some aggregate sense. Yes?
What's the relationship between the statutory rate and the actual rate? Because sometimes, you know, it's not always the case that what the law says is exactly what is necessarily followed.
The law isn't always followed, is your point?
Well, I mean, if I pay you in cash, right, then it's impossible for me to, I can't verify, I can't like contract on that, right? So that amount of money is not going to be taxable, basically.
Yes. That has been brought into the analysis. There are actually some of these programs where there are judges who make decisions whether you're eligible for the benefit, and the judges kind of change their mood over time in a way that varies over the cycle. So that's kind of been studied. But these are pure statutory. And the reason that I do that and the NBR does that is just, if you want to link it to behavior, you don't want a series that's driven by behavior. If the series is constructed on the basis of behavior, and then you say, well, I think it's causing the behavior, like, wait a second, it went into the construction. So the idea here is let's have something that depends only on the statutes. Now, of course, Congress and the president could be reacting to what people are doing. There's that behavioral link, but there's not a mechanical link here. So that's why typically in public economics, we do that. Not just public economics. You brought up earlier, well, this is like price indices. This same kind of issue comes up in price indices. You know, that BLS, who does the CPI, they're rather dogmatic, like, no, there has to be a specific good whose price changed. If people's preferences, in some sense, they change from expensive goods to cheaper goods, they don't want to account for that. But it's not clear that's the way to handle it. But BA wants to be pure and say, okay, this is price-driven and not consumer-driven. Yeah.
So I understand these include Medicare, Medicaid, and then reemployment tax. Those that has like the word tax in them. Does it also include things like health insurance or other benefits? Because you mentioned benefits, but the slides say taxes.
Well, it says implicit taxes. Implicit tax means, yes, when something is taken away because you earn more or worked more, we call that an implicit tax.
But my problem with the health insurance is that what I get from working in a very top-notch company, the health insurance is much different than what I get from working as a more regular worker or like substitutable worker. I guess, how do we incorporate them? And some of them are not mandatory. Some of them are like given by the company on their will to attract more people. Like Facebook gives free laundry, Google gives free massages. Those are also benefits. And you see them on your pay stub as well, sometimes. So do we also include them here as like mandatory?
Well, we would count, there's a comparison always being made at the individual level or the type level where everybody's the same within. Always the comparison is what do you get from working versus what do you get from not working? And what you get from working would include fringe benefits and things like that. Now you could get into the question, well, are employers providing fringe benefits that employees don't like? That we haven't got into here, but one could do that.
My question is actually more a methodological question. When I do a work like this, like what is the source of my numbers? When I go to that source, do I look at the books of the companies? Do I look at the pay stubs? If I look at the pay stubs, what are the lines that I'm using here? It was more like the question maybe.
Well, employer cost is a key data set. So we asked, what are employers spending on employees? And they, of course, they treat fringe benefits as a cost.
So we take the employee cost and then we take the pay stubs or like the incomes and then the differences, the benefits and everything else.
The pay stubs factor in some degree, but also particularly the programs. And we look at, well, what programs are they eligible for? How likely are they to participate in those? What are the rules of the program on the basis of what they're earning? Good, yeah, good questions. So